start the process. There you go. We are recording. We are going to talk today about navigating an uncertain economy. I'm going to share with you 8 proactive strategies. You're going to be able to Q&A afterwards to me and then talk with people. I'll talk about that in a second. The reason I'm sharing this webinar is that obviously there's a lot going on in the news and a lot of uncertainty in the marketplace. And so these 8 proactive strategies are meant to give you a way to move forward, really, right? Not a silver bullet, but maybe 8 silver bullets. And so this is an hour-and-a-half webinar, and this is a new series I'm beginning. It's a quarterly webinar series. It's a deep dive. It's a way for me to give back to people on my email list, right? It's free. I want you to show up. It's a way to stay conversant and keep things interesting and not just newsletters from me, but obviously for some of you who are clients, we talk a lot, but for many of you, this is a chance to interact, converse, etc. So 45 minutes of presentation, 15 minutes of Q&A, and if there aren't any, we will go right into breakout rooms. These have been a big hit on all my events, and we'll put you into rooms of, let's say, 7 people. And it's a chance for you to talk about with other peers what you've just learned here. It's a place to network, to ask questions, to share your biggest aha. People really love this. And so we are integrating this into every webinar. If you can't stay the whole time and only the first 45 minutes, great, I'm glad you're here. And if you can invest a bit more time, you'll really get a huge amount of value towards the end, guaranteed. And so 7 points of uncertainty. There's a lot of uncertainty and it changes weekly. I was going to give this talk last week and the economy is already changing a bit since then, right? Things in some ways are looking better, but still plenty of uncertainty. So it changes every week. There's a lot of fear mongers out there I am seeing and hearing. I was listening to a podcast, I won't tell you who, and they're talking about, oh, we're in for 4 years of downturn and blah, blah, blah. Now, this is also somebody who sells tickets to an event that they're going to have with famous speakers, right? This big global event that you pay money to go to. And I'm thinking, oh yeah, fear mongering, put fear out there and then try to sell you the solution. A lot of media does the same with the clickbaits. So you really have to think for yourself, what is going on? Take in the information and make your own decisions. I spoke to Dr. Charlie Hall. He's been a guest on my podcasts since the beginning. And he said with both growers and garden centers that they've seen both an uptick, some have seen neutral, and others are already seeing a little bit of a downtick. So it's mixed. Even they're uncertain based on the sales that they're seeing. Mixed messages. Recession, I want to remind us all, is a lagging indicator. We know we've been in a recession after the fact, right? It's 2 quarters basically of downward economy, which gets really measured way after the fact. They can't even tell you, when you're into the next quarter, what happened the last quarter. So very much a lagging indicator. And so don't be as fearful for this whole concept of recession. Hey, we could be in one right now. I don't think we are, but we could be, and yet it hasn't been proclaimed. So again, it's an important word, but it's also used as a buzzword. And so just keep that in mind. Lead flow is how you can get some handle on these uncertainties. We'll talk about it. It's a leading indicator, right? Recession's a lagging indicator. It tells you after the fact. Lead flow is a leading indicator. It tells you what your sales will be upcoming in the future. So you really want to have a handle on both types of indicators. Inflation is definitely the driver from my perspective on what's going on. And even inflation and how they measure it is variable. Some measure year over year, some measure month over month, and they're different indicators. So when you're listening to the news, drill down and make sure you understand which type of inflation they're talking about. Inflation is going up, according to the last indicator, but oil's coming down. What's going on? I think energy is a big driver of inflation. And I think before we know it, we're going to have a surplus. Not yet. Mark my words, we're going to have a surplus of oil. And so that, but right now that's driving inflation because it also drives goods to market, right? How do you get food to market? You need oil. So oil permeates everything. Oil, labor, supply chain. We're working the bumps out of the supply chain. So that should ease inflation and continue to ease inflation. However, counter trend, globalization is turning into slowbalization. And that means that we're disconnecting from being just in time and we're building up inventories. So that will raise costs. The cost of doing business will go up. So we've got sort of these counteracting trends going on. Rents went up. Now rents will take a long time to go back down. So when you hear on the news that, oh, this will take a long time for inflation to come down, what they really mean is rents. Rents take a long time. Oil can turn like that. It can turn gotta get that snap down. Oil can turn pretty quickly and bring costs down. And so inflation has a long tail, but only in certain aspects of it, like rents. And lastly, we've got the housing bubble, which people say isn't a bubble because there's such a low inventory and huge demand long-term. Having said that, interest rates have been very low, which has created a bubble in pricing. You can see the bubble in pricing. It's right in front of you. And so as the Fed ratchets up interest rates, it is going to impact housing quickly and before it impacts anything else. It impacts the whole build industry. And so if they have to keep that up, then I think it will pop the bubble in some aspect and may cause some type of recession in the next 12 months, let's say, maybe 6 to 18 months. But they're going to be ratcheting up the interest rates based on inflation. And we just spoke about what drives inflation. So watch all these dynamics and it'll give you a lot more certainty on what's happening in the economy. Okay, 8 points to remove and deal with and navigate uncertainty. Number one, most important, is remove uncertainty with your employees. That's really the absolute smartest, best thing you can do. Even if you have uncertainty, you can still remove it from your employees. And you do that through communication and sharing. I'm going to give Drost as an example. I'm holding my Summer Growth Summit there in August, end of August. And this company, which is a very high profit, high cash producing company, you're going to learn when you go there that they do an excellent job. They really set the bar for what sharing looks like. They're open book management, so employees can see what's happening in the company. They put their money where their mouth is, so their profit sharing, which is done very well for everybody in the company and them, high double-digit profits. And so they remove uncertainty by giving monthly updates to the company. Here's how we're doing. And so every month you can go to this meeting and learn how the company is doing. You can ask any question you want, very transparent. They're the host of my Summer Growth Summit, and they don't, I spoke to the GM. He doesn't care who comes, competitors, et cetera. They're very proud of their transparent approach and the value it's built in the company and for the employees. They do a monthly deep dive, the GM does, with their managers, with each manager. This is a no holds barred. They're allowed to talk about any metric, and they are very metrics oriented. which you'll learn when you go to the summit. And as you should be too, because that removes uncertainty. And they do a monthly deep dive, which makes sure that all the managers, all the division managers are on top of their numbers, understand their numbers, have explanations for what's going on. And then they have weekly department meetings, whereas teams, and they have it across the company, so different teams have different weekly meetings where they dive into key metrics, key issues. And so an intense amount of management by the metrics, sharing, discussions. That removes uncertainty from top to bottom, but also from bottom to top, right? In leadership, you can't be surprised either. And so you want that uncertainty being navigated or, dealt with in both directions, top down and bottom up. Now, as a GM, if you're a GM running a company, one thing you can do, this is sort of a to-do that you can copy here, is set up, and a CEO can do this too, right? Any owner can do this. But if you're coming on as a GM, I think it's especially helpful, setting up a monthly scorecard where you meet with your employees, whether you're doing open book or not. And even if you are doing open book management, there's a lot of information in the books, right? In the P&L. And so pick 7, 8, 9, 10 indicators and give an update on them every month. Some of them should be leading indicators, inquiries, etc. Some should be current. Here's what's happening, right now this month. And some should be, in client satisfaction and not just financial indicators. And some should be lagging. Here's our year-to-date performance. Here's our retention strategies for clients and employees. So you can pick leading, current, and lagging indicators, financial indicators, client, employee indicators, and whatever else might be important to your strategy, but not too many. And then you give an update every month on the same indicators. That helps remove uncertainty with your employees. So first and foremost, you have to remove that uncertainty and keep removing it. It's a constant process. Number 2, fuzzy leading indicators. You have to get a handle on these. And it's not easy. They're fuzzy. Some are concrete, many are fuzzy. You still have to get a handle on them. There's external and internal indicators. The external you have to cultivate, the internal you have to collate. So cultivate and collate these leading indicators. So cultivating external indicators that might be things like talking to builders, right? A lot of builders are looking out a couple of years ahead. You might be looking at building permits, gathering building permits. I used to do this back when I ran a pool and landscape company, and we would look at pool permits. Who's building? How many are being built? What's our percentage of market share? We could tell just from the permits. And so you can also talk to architects and landscape architects. It's their job to be planning work that's going to get built a year from now, 2 years from now, 3 years from now. I used to have a landscape architect. I'd call him up like once a year, maybe twice, but generally in the spring. And I'd say, hey, what do you got on the books? How does your year look? Because his year would be some type of indicator for how my end of year and the year following would look. And so cultivating those relationships is very important. You might have a big company in your area, like Reader Landscaping, a longtime client. Their region is Dow, I think it's Dow Chemicals or Dow Corporation, is a huge impact. So how's that company doing? I can tell you what, he keeps his tabs on how that company does. And you may have a few companies where you are that you want to keep tabs on. Suppliers know a lot. So again, when I was running my pool and landscape business with my family, I would call Bell Aqua, big supplier. They supplied all the pool companies up and down the coast. I spoke to the owner. may he rest in peace. His name is Marty. He knew what was going on. And, we were good friends. He goes back. I mean, him and my dad were good friends, and we were a really big client. And he would tell me everything, nothing confidential. I'd get the whole lay of the land. So cultivate your external relationships, collate your internal data, get on top of your inquiries. Inquiries are people that they're not leads yet. You haven't met them, but they're phone calls, they're emails. You want to track this year over year and have a good handle so when there's a drop. You want to be able to track that. And leads, I differentiate inquiries and leads. Leads are appointments. How many appointments are we going on? Because in theory, you're qualifying bad leads, and so you're only going on good leads to some extent. Everyone does it different. But that's an even tighter metric. And then, of course, your closing ratio on those leads. Business might be going so good right now that you don't need to track. And then, of course, when things go upside down, you're lost and you wish you had tracked. So this is something that you want to track now. Good times, bad times. As you grow your sales team and salespeople, you're going to need closing ratios, and you'll want to be tracking that. So get a handle on your fuzzy leading indicators. It will help you navigate uncertainty, and in fact, know if you should be more worried or less worried than what you're reading out in the papers. Okay, number 3 out of 8. Focus on cash flow, but don't gorge on cash flow. I see a common advice that companies receiving is, hey, build up your cash when the economy gets uncertain. And I find that advice, let me think how to say this. It's kind of like God saying to Noah, hey, it's going to rain in a couple of weeks or a month, maybe a month and a half, maybe 2 months. Build a boat. Go build a boat. And if you're Noah, you're like, what? What do you mean it's going to rain? Well, build a boat? What are you talking about? You can't react that quickly. So when they say build up cash quickly, it's hard to do unless you just stop spending like that, which is not necessarily good either. But the other problem with cash flow, with gorging on cash flow, is that it makes you lazy. It's like overeating. You ever overeat and you're just like, oh, I'm so tired. Oh, I got to take a nap. I just need to take a nap. I've overloaded on carbs, or in my case, chocolate, but I don't need a nap after chocolate. But if I ate 4 slices of pizza, for sure, I need a nap. And too much cash can do the same thing for your organization. It can make you fat and happy and slow and sloth-like, and really take the edge off your step. And I'm not just saying this in concept. I've worked with companies where some of them are debt-free and they're sitting on all this cash, and they're like, well, we've got all this cash, we're doing well. But really, from a P&L perspective, they're not doing well, because it's cash on its own, or cash in the bank on its own, is not a good metric. It's a result, but it's not a good metric for how well the company is performing. And like I've just said, it can actually throw you off. If you manage your business like you might a checkbook account or savings account, it can throw you off, because that cash can fill up for all kinds of reasons. Big deposits, timing of expenses, all kinds of reasons that your cash can build up, completely independent for how you're running your P&L. And so what I would recommend is being lean on your cash. And I'm going to talk about that in a second. Actually, I'll talk about it now. I'll reverse the order of the slide here. So what I would focus on is keeping your company lean of cash, not fat of cash. And so as the owner, I would pull the money out of the company and put it into a different savings account. And I would ask the company to operate on less cash. The whole purpose financially of a company is to create cash, to throw off cash, they call it. It's that company throws off a lot of cash. That's what you want your company to do. And it doesn't just happen, it has to get honed and fashioned in a way to do that. And so I would as the owner, remove the excess cash from the company at the right moments in time, and make sure the company leadership team can set up its contracts and hold its clients accountable and hold its managers accountable to the contracts and the budget, so that you reproduce cash and fill the coffers with cash. Your company most companies don't always need your cash. Generally, if you map your cash usage over the year, you're going to see there's a trough, maybe a couple troughs. All right, we need to lend the company some money back for the winter, for example, just making this up, or for early buy. But then at a certain date, it should start producing cash, and I'm going to pull the excess cash out of the business. So every company, you have to figure it out, but I would advise doing the opposite. Store up on cash, but remove cash and make sure that you can operate lean and mean. So the owner controls the cash, the GM creates the cash, and you may have a business that's where you're both owner and GM. Most companies are. Not very few companies have a separate GM. Many do, but in the grand scheme of things, it's often the owner who's the GM, which is fine, depending on your size of a business. And owners have to realize they have two hats. I've got the owner hat. Let me put that on and off. Oh, and I have the GM hat. That's where I get down into the operations and make the business work. The GM's job is to make sure the contracts are written correctly, and you're accountable to the contracts and collections, and you're hitting your budgets, and you're creating cash. And that's one definition of success. In the slide here, up in the middle, there's really three definitions of success financially. ROS, return on sales. That's called net profit, right? Return on sales is net profit. ROA, return on assets. What kind of profit do we make for the assets we put in the business? Cash is an asset. And then there's free cash flow. How much cash is the company creating? And so those are really the three metrics you can use to measure your profitability and your performance. Not profitability, the performance of your business. If you want to learn more about it, two books I recommend that my clients read, and I would recommend you read. One, it's an older book, Managing by the Numbers. It may be out of print. Chuck Kramer, great book. You might need your QuickBooks to open when you're reading this book. Excellent book. And the other one is called The Ultimate Blueprint for an Insanely Successful Business by Keith Cunningham. Ignore the last chapter where he tries to sell you things. Don't buy them, but buy into the rest of his book. Although the first chapters, these two good books will give you a good understanding on some of the things I'm talking about here. So focus on cash flow, but don't gorge on it inside the company. Number 4, don't hunker down. This is one of the first things we did after the crash in 08, 09. People hunkered down. You can't do that. You have to increase communication. You have to make use of technology, Slack, for example, or other communication tools. Many applicant tracking softwares also have communication tools like Slack built in. You want to make use of meetings. You want to make use of one-on-ones and just running into people out in the field or in the yard. You literally have to increase communication and don't hunker down, don't go on vacation more often, in a downturn, but get out there more, increase communication. Number 2, you need a growth mindset. Some of the best companies in the last couple hundred years were created in the big recessions and the Great Depressions. Everything is cheaper there. Marketing is cheaper. Don't cut down on marketing, increase your marketing. Equipment can become cheaper. Buying other companies, cheaper. Easier to get better employees without overpaying. You know the expression buy low, sell high. It's a time to buy low, to get market share. So be in the growth mindset. Now the game is on. Number three, be optimistic and smile as you walk around your company. A lot of owners are thinkers. You're always thinking, you're in your mind, you're processing. And when you do that, a lot of people look angry. You actually look angry when you're in thinking mode. Dave Wright might be listening. He's a client, and we've learned that about him from his employees. And he's a really tall guy. This is a Canadian Dave Wright. I know a couple of Dave Wrights. And when he's in thinking mode, he kind of looks angry. A lot of people are like that. So be optimistic, be present, look people in the eyes, obviously, and smile. Play offense. Don't hunker down. Don't play defense, because now's the time where you can really take advantage. Sometimes I have a lot of invested in the stock market, and me and my financial planner, like when we see the stock market drop, I'm kind of like, oh, this is good. Now we can go and buy some more stocks when everyone else is selling, right? Buy low, sell high. Do the opposite of what the market is doing. Look to do the opposite. Number 5 out of 8, should you build maintenance? Again, I want to go back to God and Noah. God says to Noah, hey, it's going to rain. We got a storm coming. It's going to be a flood. I think he lived in New Orleans, because man, did it rain last night. Man, do we have a lot of floods here. But nonetheless, he probably didn't live in New Orleans, but it wouldn't surprise me. And so God says to Noah, hey, it's going to rain in a couple weeks or a month. You better build a boat. No, that's not what he said. But you kind of see that advice. Quick, build up your maintenance. We're going to have a downturn. You can't pivot. You can't turn on a dime. You can't do that. It doesn't make any sense. Noah was planning way in advance, and you need to as well. A cautionary tale is Vila and Son. I know Vila's great people. He was riding high in 2008 in Florida, and a lot of bid build, just riding high. And when that thing collapsed, he went in 1 year from riding a helicopter, checking out his projects, to being bankrupt. They tried like heck. The snaps. They tried like heck to build maintenance, and they couldn't do it fast enough. It wasn't in their DNA. And it wasn't something that they had a pipeline of. It wasn't who they were. I think they could have turned things around or given it a better shot, but they had a poor handle on cash flow, and that exasperated their problems in their business. So not just low margins, but didn't have a good handle on cash flow. So you have to manage both. But my point is, boom, 1 year to the next. You can't just build that boat. You shouldn't try to just build maintenance all of a sudden. It doesn't make sense. So I think that strategy is sort of poo-poo. But as a long-term strategy, I like it. If you want to build enterprise value, make your business more saleable, sure, you should build maintenance. If you want to make your business more stable, you're going to, for those of you that are going to visit Dross Landscape Summer Growth Summit, August 29 to 31, I've been telling them for years, build your maintenance. For years, they must have thought I was an idiot. Who is this guy telling us it's going to rain 5 years from now, 6 years from now? I just said, wow, you're so DB heavy. You should build maintenance, because they have a very DB centric culture. Darn, man, do they have an awesome integrated maintenance part of their company. It's pretty cool. they're doing all kinds of recurring revenue services. So it makes a lot of sense as a long-term strategy. And also defend your properties. I was speaking to, let me think. I'm going to think of the name of the person I was speaking with. Let me pull it up here in a second. Ron Edmonds. I was speaking to Ron Edmonds, and he concurred with me about one reason to build maintenance is defend your client's properties from competitors, right? Keep competitors off. That's another good reason. Maintenance may not be in your DNA, but by doing the maintenance, you keep others off the property. These are long-term strategies, but you've got to stay true to your passion. If you're a pure DB company and that's all you want to do, there's other ways to deal with navigating uncertainty. My brother's a great example. He runs a pool and landscape business. This should not be any surprise, by the way. I have multiple brothers, cousins, uncles, all with pool companies. We're the pool mafia in Connecticut, or one of the couple branches of the pool mafia in Connecticut. So one of my brothers has a pool and landscape business. All he does is install, doesn't want the maintenance, gives it away. I'm not even sure he sells it. But he has a very flexible model. He subs everything out. He uses outsourced vendors. When 2008 happened, he just scaled back. He didn't close his doors. He just scaled down and he scales up. And he's got no worries whatsoever. That's his model. I am not saying you should do his model, but he's got a strategy. You can be more flexible. Like, he does not have the employees in-house, but you can still use remote services while keeping your install crews in-house. Your design services can be remote. Your accounting services can be remote. In fact, they can be overseas, where it's less dollars per hour to hire these people. Your admin can be remote. Your estimating can be remote, or takeoffs. There's a lot of flexibility today where you can have remote, overseas, and outsourced overhead to keep you more flexible so you can scale up and down. So should you go out and build maintenance? Should you run out and build that boat? No. You should do it as part of a long-term strategy, while also staying true to your passions and building flexibility into your organizational structure. That's number 5. Going to give you 3 more proactive strategies. Marketing. You really should always be marketing. And in bad times, you should market more. But in good times, you should market. Too many people I speak to, they're like, well, we don't market. We don't need to. The work just comes to us. That means you haven't built up a marketing muscle. You don't have the innate skills built up in-house, and you can't just turn it on and turn it off and speed it up, which you need to when the economy gets uncertain. And so marketing is both internal and external. So internal is enhancement sales. Many of you, that's right, you know who I'm talking about, you aren't taking advantage of enhancement sales because you're just too busy with the phone ringing and you're going after the bigger sales. But enhancement sales are more profitable. If you're not handling enhancement sales, your clients are using your competition, guarantee it, 100%, I'll put money on it. If you're not taking care of enhancement sales, your competition is servicing some portion of your clients. So you should always be building in enhancement sales, even if it means you can't handle all the install work. It means you're taking care of your clients because they have projects, they want to spend money. It means you're loyal to them. Number 2, a newsletter to your internal clients. To your internal clients. I won't mention here, but I always tell all my clients, I always share with them, one of my favorite clients has a newsletter, which is excellent. And I have all my clients go sign up. And his company's newsletter is frequent, informative, sells, and it's not just once a month, it's a lot more frequent, but lots of value, just like my newsletter. Lots of value. His clients look for it, part of the internal marketing strategy. Number 3, multiple relationships. You want to build multiple relationships with your clients for the most part, so that there's communication going back and forth and there's loyalty. It might be the account manager, it might be the foreman, it might be the office admin, might be the original salesperson. Multiple relationships is a form of marketing, especially when you orchestrate everyone to help find needs, plant seeds, and even promote services. But even putting that aside, just the flow of information is part of that building relationships and marketing to your clients. And lastly, a great French word, a New Orleans word, lagniappe. That's a little something extra you do for your clients. The client delight, you probably know it as. Now, lagniappe is great when your clients are happy. You can't throw little gifts at your clients when they're unhappy. My original landscaper on my backyard, we did not part happy. He brought me a Christmas gift. It was very nice of him, but I was unhappy with the overall service. That gift almost seemed like he was tone deaf. I mean, it was nice, thank you, but gosh, make me happy on all these basics and then give me the lagniappe. So it has a role, but make sure it doesn't backfire. So that's internal marketing. And then external marketing, do 2 things. Assess your online reputation, build your online reputation as a recruiter of new prospect clients and employees. Build your online reputation across the board, manage it. And that's the starting point. And then upgrade your marketing, work with outside firms, test out new firms. I always have a couple I can recommend, and be spending some money there. This is what I want you to do in good times and when things get uncertain. Okay, we have 2 more here. And so we're going to end roughly on time. I'm glad for that. And then we'll go to Q&A, and then we'll go to breakout rooms. Number 7, upgrade your sales process. What do I mean by that? Well, first off, who's your sales manager? For most companies, it's the owner until it's somebody else. And then that somebody else is often a salesperson doing double duty. Yeah, that works until it doesn't. Trust me. It's working, it's working, it's working. No, it's not working. It works until it doesn't. And then at some point, it becomes a dedicated sales manager. In any event, who is that sales manager? Because they've got a job to do. And here's 6 bullet points, things they've got to be doing when times are good, but also to help you navigate uncertainty. They should be hiring real salespeople, not just promoting people that are, they're good at relationship building. They're good at technical. They did selling somewhere else. They're good at one part of selling, like estimating, I don't know, or project management. And so people get promoted into sales for all kinds of reasons, except that they're good salespeople. I'd rather you hire a salesperson from outside the industry and train them than hire somebody from inside the industry that is never going to make it as a real salesperson. Number 2, sales managers got to make sure the qualifying process is dialed in. You've got to dial in the qualifying process. As you market, you bring in a mix of good and bad leads. You've got to protect your salespeople's time and protect their ego. You've got to protect their ego. Salespeople are sensitive people. They are insecure people. They have bravado, they have confidence, but deep down, they can get off kilter if they're trying to sell the wrong person who is price shopping or rejecting them for the wrong reasons. So that's the qualifying process. Number 3, sales manager's job, rapid response. See, even my dogs agree with that. You can hear the dogs. Rapid response. That's what my dogs do for me. They have the rapid bark response. But the sales manager's job is to always ensure that your response to your clients is rapid. How do you win sales in most economies? You call them back and you show up and you do it pretty quickly, and that gets you the job. And when you're too busy, I see the response time slowing way down, totally unexcusable. You have to have rapid response in all parts of your company. Number 4, selling to needs and wants and pain. You've got to learn how to identify pain and sell to pain. You can't just sell to the wants or the needs. Some salespeople walk in the property, see the needs and ignore the wants. Other salespeople show up and they just hear the wants and try to do order taking and don't establish the needs. And both of those people need to identify the pain, and that's when the real selling begins. And then if people push back on the price, you don't fold, you don't just try to give them a better price. You got to believe in your value and sell the value. Lastly, your job as sales manager is to remove the roadblocks, external roadblocks, internal roadblocks. You've got to always be identifying where those roadblocks are and figuring out technology solutions, other solutions that remove those roadblocks. So point 7 here, and this is just one of 8 points, upgrading your sales process will help you greatly now and as you navigate uncertainty. Number 8. Number 8, we're a little bit over time here, but we're not too bad. Be nimble. To be nimble, you basically need 2 things. First and foremost, you need strong operations. You've got to have strong operations so that you're not doing this internal firefighting, so that you can, as a leader, be on top of things, see the forest for the trees, and be nimble. Consider open book management and profit sharing as a way to pull all your team together and solidify the operations. It's not a silver bullet if you haven't done everything else, but once you've done everything else, it can really act as a glue that binds everyone together. So number 2, invest in A players in your inner circle. Don't be cheap when you're building your team. Be expensive. What's the opposite of cheap? Expensive? Don't be frugal, don't be cheap, but don't be penny wise and pound foolish. I'm trying to come up with the antonym for cheap here while I'm talking. Look for the ROI where you're going to get the R, the return, not the ROI because it's a low investment, a cheap investment. So that's the whole numerator and denominator. You want to look for the return, which is the number on top. And to get that, you want to really invest in A players, invest for the future. A strong inner circle helps you in good times, helps you in bad times, helps you in all times. Jack Welch proved this out years ago, decades ago, in a study he did with a futurist. They brought the futurist in. They came up with multiple scenarios, how the world economy might go, up, down, sideways. What do we need to do to be prepared? The common denominator was a strong team. So invest in this inner circle and then remove weaknesses in sales, ops, admin, HR. Remove, that might be the next level down in the company, might be a couple levels down, remove those weaknesses. And now we have a strong operations. And that will free you up for strategic moves, for being nimble, right? So in summary here, remove uncertainty with your employees first and always. Do that, lean into that. Number two, get a handle on your fuzzy leading indicators. You've got to have data. You can't use your gut. Number three, focus on cash flow, but pull it out of your company instead of putting it into your company so that you can be lean and mean as in operations. Number four, don't hunker down. In times of uncertainty, that's where the opportunities will show up. So have that growth mindset, play offense. Number five, don't just build maintenance because everybody else is, but build it for strategic reasons and do it in a strategic way. Number six, marketing, internal, external marketing in not just bad times, but figure it out in good times so you can use it when times become uncertain. Number seven, upgrade your sales process. I want you to have a killer sales process that's going to jump your company forward independent of the economy. And then number eight, to be nimble, you've got to strengthen operations and invest in your leadership team. So before we go to Q&A, just want to say a little bit about my Leaders Edge peer group. A lot of what I'm talking about here, you have already learned through, if you're a member of one of my peer groups, and if you're part of my community of 100 landscape business owners from the US and Canada, then you're already privy to this. And if you're not a member, consider it. Look on my website, reach out. It changes people's lives. Literally, that's what people tell me. It changed my life, not just my business, but my life. So when we go into breakouts here, I'm sure there'll be some clients there. Talk to them about it. You will not go wrong. It will be a game changer. If you're thinking about ways to grow and improve, that's a very strong, high ROI way to grow your business or profitability, but also your fun and joy of your business and your life. Okay, we've got time for 10 minutes of Q&A here. Let's see how we're going to do this. I guess what I'll tell you to do is raise your hand. There's a hand raising icon on your Zoom, and you can use that and I'll call on you. So Scott, you're first. I'll even take you off and you can talk here off mute. What's your question?
Jeffrey, question for you. What should we use for benchmarking percentage or grade for closing sales?
Man, that's a great question. So it's going to depend on different parts of the business. I spoke to somebody, he might be on, I won't mention his name, but he said his closing ratio was like 3% or something really, really low. And that really kind of freaked me out. I'm like, really? How could that even be? And he was doing bid build. And if you're doing bid build, you might be 5% or 10% if it's truly, low bid, let's say 10%. But if you're doing bid build where it's negotiated bid, it could be upwards to 30%. And I have some clients that do niche bid build. I guess I won't give away the secret, but his is almost 100%. He's one of only a couple of providers in this niche municipal bid build. So there's a hint it's municipal. In design build, if you're doing designs, it should be very high, 75%, 80, 85%, maybe 90 in there. If you're doing maintenance, it could be as low as 33%, though I'd rather see it at 50%. And if it's highly qualified residential, it could be even much higher than that. So when I analyze a company, I want to look at how much effort they put into sales and how qualified it is. And from that, set some closing ratio targets. So for example, If you're going through the effort of design and you're doing design build and you're only closing 50%, yeah, something's wrong there. That's too much effort for not a high enough closing ratio. The bid build example of 3%, crazy, too much effort, right? So there's some quick thoughts for you on benchmarks, Scott. Does that answer your question?
Does, thank you.
Excellent. So Naveed is next. Naveed, what is your question?
Can you hear me, Scott?
Jeffrey, yes.
Mr. Jeffrey Scott. So, Mr. Jeffrey, here's well, I had another question, and the previous gentleman brought up a good point. And so our closing rate is lower, but we have very high volume in sales, and we meet a lot of clients. Now, what margin would you correlate with a 75% sales? Because I'm sure the supply and demand curve, right? The higher your price is, even though people love you, they still ask questions and question whether they can.
You're asking me a lot of questions, but let me throw a couple at you. And by the way, there's chat in here if you want to ask questions, and other people will answer your questions on chat. That's the beauty of the chat here.
Right on.
So what is your closing ratio, Naveed?
40 to 45%.
And what's the product or service?
Oh, design build only, 100%.
That's kind of low, I think. Are you charging for design?
Of course.
Yeah, that's too low. You're not, I suspect you're not doing enough selling, and you're doing too much of, you're not doing enough pre-qualifying, not enough pre-qualifying, not enough of a selling process. You know, sales happens in person. Not enough, yeah, those two things, not enough qualifying, not enough selling. I think that's too low of a closing ratio. And so now
I appreciate your honesty. I'm
Yeah.
happy to, I'm happy to get with you after the conference in a day or two, and maybe we can do a deep dive. But no, we have a pretty amazing process, and honestly, we kill it. However, I do think our margin, what we're asking for, is very high, and that's really what I was kind of looking to see. What is a going margin for, you know, exclusive design build companies that they look for?
So you're selling, your closing ratio is 45%, let me say. If you could get that up to even 55, you've got almost 25% more sales. That's a lot. So you may be killing it. And one thing I've learned, Naveed, in my years, I hate to say decades, but there you go, I just said it, decades, is companies that have strengths often have even more room within that strength. So just because you're so good at it, and I believe you, that you're great at it, it doesn't mean you don't have more leverage there to get even greater at it. So I would urge you, and I urge everybody, don't just look at fixed weaknesses, look at your strengths and just see if there isn't, in fact, more leverage there. So now back to your margin question. It's a bit all over, and it depends if it's hardscaping or softscaping and how much you sub out, but let's say 55 to 65% gross margin, 50 to 65%, depending on the mix of subs. But I would lean towards the higher end, roughly. You might be higher, you might be right in there.
Okay. Well, thank you so much for answering part A. Part B, I wanted to ask.
Naveed, now you have to share a little bit. What is your margin?
Man, it's so hard. I don't know who's from my market, or I've got a unique name. I prefer not to say, but let's just say I am in that range that you were mentioning.
Okay.
Or at least we strive for it. Do we hit it all the time? No, there's a cost for customer service, but we do strive to be in that interval.
And it depends on how much you're subbing out and the percentage of materials and the kind of work you do. So, you know, okay. What's your next question?
So next question. So all right. So I can almost speak for everybody in this group. We all started the company pushing lawnmowers. You brought up passion, and I absolutely despise lawn maintenance. Um, Seeing the lack of labor, seeing the demotivated employees out there. I'm trying to gather rock stars. And how have you resolved the volume game of maintenance with employee issues, with high rise of gas prices? And so that's part B of the question. And part C is, how can an exclusive design build company like ourselves thrive in whatever economy that we're about to get to? Because we are going to try to
Well,
add more design build services, but not
yeah.
add maintenance.
Where are you located?
Atlanta.
In Atlanta. Okay. Yeah, Atlanta's a pretty competitive market, especially for employees. Now I have to remember all the parts of your question. Oh yeah, maintenance. So Dross Landscape, where I'm holding my Summer Growth Summit. Kareen, maybe you want to throw that link in the chat? Hold on, I'm going to talk to my office here for a second. For the Summer Growth Summit. So we'll put the link in the chat for the Summer Growth Summit. They do high-end design, and they have built maintenance, and it works well. So and they make high profit on it. So it doesn't have to mean low profits. Mowing can be capital intensive, right? But tree is capital intensive, and you can make quite a bit of money in tree. And all the other services, gardening, etc., fertilizer, lighting, those can all be very high margin. And so I don't think maintenance is low margin, like you're saying. Okay, in Atlanta, it's very competitive to do mowing, sure. But if you're doing super high-end work, then there's a need for high-end maintenance. And to your other question, being nimble, I think I really covered different ways to do that. You're going to have to go back to your team and look at applying some of those recommendations.
I agree. I mean, we've got about 5 different strategies that we are trying to assess and prioritize, because each one's going to take 3 to 6 months, but we want to make sure we're taking the right steps toward the top, strategy or top 2 strategy, and not go through the wrong one, because we've just always grown through design build. We do decks, porches, we do everything outdoors besides pools. We're planning on adding pools, which is one reason why I wanted to speak to you in private. We want to develop that department.
Do you do plantings?
Oh, tons of it, yeah.
So how old's your business?
How old?
Yeah.
Depends. From the moment I started mowing lawns when I was 14,
No,
21.
The business.
Professionally, we're 11 years old.
It's never too late to start high-end maintenance. All those plantings that you've built could all be high-end maintenance clients. It's never too late. Don't do it because of the economy. Do it because you want to build a profit center. That's my thought. All right. Thank you, Naveed.
Thank you, sir.
So we're going to now shift to breakouts. Kareen, are you ready to put people in breakouts? We're going to put you in breakouts of 7 people. If we find that there's only 1 or 2 of you in a breakout, we'll move you to a better breakout. And you're going to be there for about a half an hour, and then we're going to close down the Zoom. So you've got a half hour to network and enjoy your breakouts. Share one aha with everybody else in the breakout. That's a great way to start. Kareen, open up the gates. Well, then reset it and let it go. We're just setting things up. Some people are jumping off. They've never been in a breakout. It's a shame, because that's where there's so much value. Kareen, just let it go. Pull the trigger. All right, we're putting you into the breakouts. You have to then click the button to make it in.